Today's webinar is about property division in Washington State, and my name is Melissa Rosenberg. I'm joined here by Michelle Dellino of Dellino Law Group. I'll take a quick moment to tell you who I am, and then I'll turn it over to Michelle. My name is Melissa, like I said, and I am a private practice therapist who specializes in the area of divorce and separation and supporting people through relationship transitions. I work with both individuals and with couples in therapy to support them emotionally through these processes. And it really works well, often in conjunction with family law cases due to all of the complex emotion involved. Today, though, I'm here as a moderator for this webinar. And I'm here to take questions as they come in and pitch them to Michelle and make sure that we answer all your questions as much as possible. So what will happen is Michelle will start the webinar. She'll deliver a lot of great content about this topic. And if you have questions that you would like to ask throughout, the best thing that you can do is put them in the Q&A. So go ahead down to the Q&A on your Zoom screen and enter a question, and I will then ask them to Michelle, make sure that we get them answered, as many of them as possible. One note about that, if you would like to ask a question anonymously, please do that by clicking the anonymous option when you enter your question. Otherwise, your name will come up and other people on the webinar will see who asked the question. If that doesn't matter to you, go ahead and ask it as your name. But if you want it to be anonymous, I just wanted you to be aware of the option to do that. At the end of the webinar, we'll put up a slide with our contact information in case you'd like to be in touch. But yeah, let's go ahead and kick it off because this is an important topic that a lot of people have a lot of questions about, property division in Washington State. So I'll turn it over to Michelle Dellino.
Hi, thanks for being here. I'm Michelle Dellino. I'm a divorce and family law attorney in Washington State. I'm an attorney, but I am not your attorney unless you are watching this and you're a client of mine. But nothing I say here, it should be construed as legal advice. It is informational for informational purposes only. Melissa did mention earlier that if you have questions, put them in the chat. And that's great. I'm happy to answer as many questions as I can get to today after I give you some content. But please be advised, if you asked me a super fact-specific question related to your case, I'm not going to be able to give you a full hypothetical answer. So you can ask me general questions. And if you have super case-specific questions, those are the kind of things you would want a confidential consultation with me or any other attorney about. So I just want to put that out there. So if I don't get to your question because it's a really convoluted hypothetical, that's probably why. That happens almost every time. But anyway, I've been practicing divorce and family law for over 14 years. I'm the owner and managing attorney of Dellino Law Group. We have 8 family law attorneys here and a full service family law staff. All we do is family law. Sometimes we do really high conflict work. Sometimes we do mediation. We do all kinds of different things here. But one common thread in every divorce is property division. Whether you have a little bit of property or a lot of property, or you think you don't have any property, maybe you don't know what property is because that means different things to different people. You have a property issue if you have a divorce happening. So part of this is for you to have a basic understanding of property issues in Washington State. And maybe you don't have a divorce. Maybe you're thinking about a prenup or a postnuptial agreement, or maybe you're living with a partner in an unmarried relationship and you don't know that there's property rights that attach there. Because guess what? There are. Living with people in Washington has totally different connotation than certain other states, and community property like rights can attach. So there's a lot of things to know. So anyway, the whole point of this is property is important. It matters. So you need to know about it. So that's why I'm here to give you a little bit of an overview, maybe to answer some of your questions on one hand, and maybe to give you some things to think about that maybe you hadn't considered on the other hand. So first of all, let's talk about what property issues you need to know about. Community property and separate property. What do those things mean? If you have looked into anything about property rights in Washington, you've heard those terms. Community property and separate property division refers to the process of actually dividing assets and debts between spouses during a divorce or legal separation. If you're doing a prenup or a postnup or a cohabitation agreement or a community property agreement, which is actually less common, you might be making those decisions when you're not getting divorced, but you're talking about what would happen if you do or separate, and those things are equally as important. So Washington follows the principle of community property, which is to mean we're a community property state. But what does that really mean? This means that all assets and debts acquired during the marriage are presumed, which means it's a presumption. It's a rebuttable presumption, but it's still a presumption that community property attaches to any assets or debts that are acquired during the marriage, and that it's subject to what we call a just and equitable division between the spouses. So first of all, let's just talk for a minute more about what community property actually is. If you were in my office, I would pull out my little pad and I would draw a circle and I would tell you, this is how I do it. I would tell you that when your community started, either when you started cohabitating before marriage or when you got married, is one end of the circle. I'll just do it since I'm here. And the other end of the circle is when you separate. And that's in it. And this is what forms your community. So let's just say you got married in 2010, and let's say you got separated in 2022. Let's just do that because sometimes this happens where people separate and they don't divorce. So what do you have? And if I was really tech savvy, I would do this on the screen, but whatever. So anyway, here's your community. 2010 to 2022, you got a 12-year community here. So everything that goes in the community, you have a house, you've got a car, you've got a sofa, because that's property too. You've got restricted stock units if you work at a tech company. You've got a 401k. You've got some credit card debt. You've got a mortgage. You have like all that stuff, right? And it's in here. So that's not very artful, but it's a good illustration for you to think about. Everything in this sphere is in here. And then you think, what doesn't belong in here? What could potentially be separate property? Maybe you got a gift from your parents or something at the end of the year and it was just to you. So you would take that and you would back that out. Maybe you got an inheritance. Maybe you have some income from investments and separate property that predates the marriage. You take those things and you move them out so they're no longer in the community sphere. Okay, so that's when community starts and when it ends and what goes in there. And the debt's in there too, so you should know that. And then you go, well, what do I do with it, right? I mean, in some states, that's an easy answer. In some states, you do that right down the middle. California is the biggest example of a 50-50 state. So a lot of people think community property and they think community property equals 50-50. No, wrong. It does not in Washington, not at all. My job would be easier and your divorce would be easier if it did, but it doesn't. In some circumstances it does, but a 50-50 state means like California, no matter how long you've been married, no matter how much money you make, everything that's community is going to be split 50-50. Not the case in Washington. I mentioned the terms just and equitable division earlier. So that's how you divide community property. You do it along what are called just and equitable lines. But what does that mean, right? Like, what does just and equitable mean? Because those are just words that sound kind of nice and serene, but they're really not. Just and equitable is supposed to mean what's fair. Well, I always say this, if you've heard me say it before, you can roll your eyes, but what's fair, there's two kinds of fair. Melissa's laughing because I like to say this all the time. There's one, and I used to always tell people, oh, there's only one fair. It's at the Puyallup every year. If you're from here, you know what that means. If you're not, you don't. Puyallup Fair happens every year. There's actually two. There's also the Evergreen State Fair. So there's the fair that you go to. And then there's the fair that you used to pay with like a coin when you got on a Metro bus. Now you swipe a card. So those are fair. There is no other fair in family law. So if you think that's not fair, he said that's fair. That's not fair to me. This is what I hear all day. That doesn't exist. Take that out. It's supposed to mean what is fair, but what is fair to me would not be what was fair to my husband if we got divorced. Like we would have totally different concepts. So take that out and think about just and equitable, really breaking down to be about what is your marriage about? How long have you been married? Are you in a short-term marriage, a mid-term marriage, or a long-term marriage? What is the financial situation of the parties at the time that you're separating? Is one person a stay-at-home parent and they've been out of the workforce for a period of time and the other person's the breadwinner? Are both people in pretty equal jobs? Is one party on disability? Like, what is the financial situation of the parties? Those are the kinds of things that are going to inform what is just and equitable, not a concept of fairness, which is not going to be the same to two people. I know I'm harping on that a little bit, but after doing this for a really long time, and having thousands of clients, the idea of what someone feels is right is, and I'm not saying that that's wrong because it's your marriage and your life, but that's not a concept that comes into the courtroom. So it's important for you to realize there is what the court thinks is fair, and that's never probably going to be what anybody else thinks is fair. Nobody really hits a home run in family law. So there's compromise that's needed to reach a resolution, and there's general principles and guidelines, which is kind of what we're talking about. So no, we're not a 50-50 state. We're just an equitable state. So the main things you look at are how long you've been married and what's your financial situation and what's the story of your marriage, really, because every marriage is handled differently. How big is your marital community? Are we talking about dividing 10 million bucks? Are we talking about dividing $100,000 and more debt than that, right? Like, so it really depends when we're looking at what the division is going to look like. Separate property. So that's about community property. There's your little community property overview. Separate property, on the other hand, refers to assets and debts that are acquired by a spouse before your marriage began or during the marriage through specific means. So if you're married, and like I said, sometimes people will, if they're giving away their money early, they'll give away the maximum IRS allowable gift amount every year to their children or grandkids or whatever. If someone gifts you money and they gift it just to you, that is your separate property. But if they gift you money and they write a check to you and your spouse, that is community property. But separate property gifts or inheritance are always separate property. So that's one thing to know. There are other specific examples too, but that's generally how it comes up. So here is a little bit of a breakdown between community and separate property. So community property, this is assets and debts acquired by either person during the marriage. What is that? It's income. So your wages, this is a big thing for people to know. And this is where it comes down to that concept of fairness again. Your wages are community. So even though you might go to work, you might get a paycheck and a W-2 at the end of the year or however you get paid, and it has your name on it, and let's say you put it in your own bank account and your spouse's name is never on it, it doesn't matter. Name on title is not determinative of community in community property state. So your income is going to be community, which means your spouse has an interest in it and you have an interest in theirs. Then you think about retirement. Well, your income earns 401k contributions or 403b if you're in healthcare, or contributions to a deferred compensation plan like a PERS plan or any number of other kinds of plans. So if your income is contributing to those plans are also community, even though your spouse's name is never on that plan. And so many times at the end of a marriage, it's like, well, that's my pension. I'm the one that worked for it. I'm the one that did it. They didn't do anything. It doesn't matter. It's community and character because it's acquired during the marriage with income. So that's something for you to know. Other things that fall under community are really obvious things like a home. Real estate is community. If you purchase it, there's a presumption that it's community. Real estate gets tricky too, because you can trace down payments back to separate property. There's separate property, other contributions made later. There might be labor. Anyway, lots of different things, but real estate. Vehicles, I mean, that's a fixed item, but a vehicle that you drive and get in, that's community, even if the other party's never on title. Bank accounts, no matter what, any account that's open during the marriage is presumed community. Like I said, retirement, savings, any assets at all. So that's just a small slice of the pie. Also, like I said earlier, debts incurred by either spouse, and this is a really controversial one. Debts during the marriage, like mortgages, credit cards, car loans, any personal loans, any kinds of debts, even if one person takes that debt out, it is community in nature. So that's important to know. I have a lot of people at some point where they'll be like, oh, well, my spouse was spending all of this money and I didn't really know. I mean, I knew they spent on credit cards, but I didn't see the statements. Why do I have to pay for that? Well, you have to pay for it because it happened during your marriage and you didn't ask questions and you let it happen and it went on for a number of years. But there can be ways to deal with that if they were spending a bunch of money on gambling or an affair or a bunch of stuff that didn't benefit the community at all. Then you might have a separate property, a waste claim against the community. So there's a lot of nuances there. But in general, debts are community if they're acquired during the marriage. So that's something for you to think about. If a spouse brings separate property into the marriage or separate debt into the marriage, it stays that way. So like, let's say I came into my marriage and I had $300,000 in student debt. I don't, but what if I did? So let's say I brought that into the marriage and I'm making payments on it during the marriage and then I get divorced. Like, is my husband going to divide that debt with me? No. But if I had gone to law school and gotten my master's degree and my undergrad degree all while I was married, then yes, that would be community debt because those loans were acquired during the marriage and for the benefit of the community. I would say, oh, well, my husband benefited from my law degree and my master's degree and my undergrad degree because I was able to earn income. And so the community should pay for that if we get divorced, right? Yes.
There's a question in here about debt. So I just wanted to ask it while you
Yeah,
were
go
on.
ahead. Let's go ahead.
Well, they're asking how debt is divided, and you just kind of answered that question, but specifically stuff in collections. Does that have any?
You guys are both on the hook. A lot of times I'll have IRS debt. There's IRS or an IRS payment plan, or we'll have accounts that are in collections, either for minor or major things. That doesn't matter. Like, you're still responsible for it. So sometimes in negotiation, if we're, trying to settle a case and we're like, okay, this person always paid this bill and they didn't pay it and they didn't return this is one that came out not that long ago. They didn't return the cable box. And so it went to collections because they didn't take it up to Comcast or whatever they were supposed to do. And they threw it away because they were mad. So that person needed to pay for that. But in general, Comcast, this is the other thing too. Comcast doesn't care that you got in a fight and your wife like trashed the cable box and like took a sledgehammer to it and threw it away. Like, Comcast doesn't care about that. All they care about is your names are on the account and it's going to damage your credit. So at the end of the day, like, we could say this person's supposed to pay for it, but the debt's not going to be treated that way. So anyway, good question. You want me to take one or two more before I go on talking about property division process?
Yeah, let's do that. There's a few questions.
Sure.
Question about information on quitclaim deed. If a spouse quitclaims on a property, how does that work? Some people might not know what that means. So if
yeah, I'll talk about that. This
one.
is a big one. A quitclaim deed is a deed. It's a very simple deed that you can do to change who owns a piece of property. So if you buy a piece of property during a marriage and you're married, it's very typical that your quitclaim deed would say so and so and so and so as a married couple own this together. Or it might say so and so, like, okay, if I buy a property and my husband's not on it, I buy it and it's like Michelle Dellino, a married woman, as her sole and separate property. If I'm buying it, he has nothing to do with it, right? And it's my money. I'm buying it, but then he has to sign a quitclaim deed saying he quitclaims away any interest in it because we're a community property state. So a common scenario. You're married, you own a property together, and at some point during the marriage, somebody asks the other person to quitclaim off of the property. So you took it from being owned by two people and now it's only owned by one. This is what happens a lot. Sometimes that's done because you're refinancing and maybe somebody doesn't stay on the underlying title, even though they usually can, but sometimes they don't because of credit factors and only one person's going to do it right now or something like that. And they're not going to be on title. That's not a reason to change the character of the property. Character of property is established at the time the property is acquired. So if you acquired it during the community, it stays community. If you quitclaim somebody off of it, and it's very clear that there's some consideration for that, whether it's money paid or something like that, or it's because you're doing it for refi, it depends on what the intent is to quitclaim somebody. If you basically just strong arm somebody into quitclaiming off of the property during the marriage, it's not going to hold up. So I've had cases where it's like, oh, well, 5 years ago, he quitclaimed off the property because I told him he had to, or we were getting divorced or whatever. Well, at the end of the day, it's still community property. Name on title isn't dispositive. So it really depends on the specifics of your situation. But a quitclaim deed is a deed that transfers how property is held. Sometimes I'll have married couples that get divorced and they have an investment property, so they want to continue to own it together. So we'll do a new deed that basically says they own it as single people, as tenants in common, which has different survivorship rights than if you own it as a married couple or joint tenants in common. So there's a lot of things I could talk about with quitclaim deeds, a lot. But anyway, if you have somebody quitclaim on or off during the marriage, the intent behind it and what you can document is going to be determinative of whether you change the character of the property. Because as a principle up front, character of property is established when the property is acquired. So if you do something later to change it, you got to be able to show why and that was the intent of both parties, not just one. Does that make sense? I think it does. Is there another question or do you want me to go on?
Yeah, there's lots, but this one also really related to this. I think it's a little bit more of a maybe too specific of a situation, but
Sure.
what if I own separate property? My husband has assigned a quitclaim deed in Washington State. I paid the mortgage on it. Will I get my house back? Doesn't matter who paid the mortgage on it necessarily, right?
No, because you used community money to pay the mortgage. If you had a prenup that said your wages are separate property, that's a different story. But wages, if you have no prenup, and I'm assuming if you're watching this, you probably don't, or maybe you're thinking about one. If you are, you should get one. I can help you with that. But if you don't have something dictating what the community is, the default is those mortgage payments that you're making with community money, right? I mean, so there's a lot of questions you can have about that. Typically, if I do a prenup or a postnup with somebody, the first thing we talk about is what's going to be community. Is it going to be your wages? Is it going to be what's it going to look like? But you have to assume that you don't get to make those kinds of calls later if you haven't done that. Then you're looking at what community property law says, which is what I just talked about. There was what we call a presumption that it is community. Let me just talk really briefly about the property division process, and then I'll take a little bit more. So, okay, this is important for you to know. During a divorce or legal separation, because this is probably what you came here to hear, what's the court going to do? Well, it's going to try to make a just and equitable division of the debts and assets. Most people do not end up in front of a trial court making that decision. I just want to put that out there. Probably almost 95% of family law cases in Washington and most places are settled outside of court. So they're settled sometimes in a mediation, sometimes in an arbitration, sometimes just through negotiation. In my experience, and I do a lot of litigating, but I also do just a lot of cases that don't go to court because most don't, we settle in mediation. And so in mediation, you are essentially negotiating on the principles of Washington law, what could happen in court, what's likely to happen, and you're coming up with a settlement that's reflective of that. So who's going to make that just and equitable division? Most of the time you are, hopefully with the help of your attorney, because I tell people this and I totally mean it. And it's not so you hire me. Like if you never speak to me or watch my videos again, that's okay, but please hire someone, please. If I know a lot about tax, but I know what I don't know, and I would never endeavor to do my own taxes. I have my own CPA, right? Because they know it better than me. I got divorced once before. And even though like I'm really good at this, it's not something that I would do for myself. So I got an attorney to handle that. When I hurt my knee skiing, which has happened more than once, I go to an orthopedic specialist to fix my knee. Even though I think I probably know what to do at this point, go to someone that knows. Your divorce is the most important financial contract that you're ever going to undo. So get somebody to help you that knows, because your idea of what is fair and just and equitable is probably not what's going to happen. So you need some help undoing that. But anyway, so during the process, things get divided. Sometimes they get divided in mediation. Sometimes if you go all the way to a trial court will divide it. But a trial court really, and they don't want to decide who's going to live in your house, if your house is going to be sold, who's going to get what. They don't really want to do that. That's why mediation is required as part of the process before you ever get to trial. So anyway, alternative dispute resolution is highly encouraged. And a lot of people think, well, I'm just going to end up in a trial because my spouse is like a crazy narcissist, which is another common buzzword lately that you should never use, by the way, if your spouse is not diagnosed as a narcissist. But anyway, everyone's like, oh, I have a really high conflict situation, so I'm going to end up in trial. You're probably not. I've had some of the most crazy high conflict cases not end up in trial. And I've had some that really haven't been that high conflict, but people just couldn't agree. So we did end up in trial. You never know. Anyway, long story short, there's going to be a division. It's going to happen. It's going to be by agreement, or somebody's going to order it. And the people that would order it would be a trial court or an arbitrator. So while Washington has a just and equitable standard, I'm going to talk briefly about the factors during the marriage that are going to determine how is it divided, right? Like, what does that even mean? What does just and equitable mean? So I talked briefly about a short-term, a midterm, and a long-term marriage. A short-term marriage in Washington is 5 years or less. And the idea in a short-term marriage is that it's backward looking when you think about property division. The idea is not that anybody relied on the community long enough to have any kind of lifestyle maintenance, any kind of expectation moving forward. It's basically meant to put people back where they started in equal positions and let them move on. Most of the time in a short-term marriage, you're often looking at a 50-50 division, or maybe a 52-48 if somebody made a lot more, has a lot more money than the other, but you're looking at pretty close to even and pretty much no spousal maintenance. Everybody just kind of gets done, divides what they have, and goes on their way, okay? Most divorces in Washington fall into the next category, or really in any state, a midterm marriage. So midterm marriages start around 6 and 7 years and go on up to about 24 years. Midterm marriage is like everything in between. A really solid common point for divorce in midterm marriages is between 12 and 16 years. I don't know why, that seems to be the sweet spot. People realize this isn't a good thing anymore for me and I want to get out of this. And so then what you have is you have two people that probably don't make the same amount of money, probably are not at the same career level. Maybe something in your marriage has happened where somebody stayed home for a while and then maybe they went back to work and so they're a little bit further behind in their career. Or maybe they didn't go back to work and maybe they've just stayed home the whole time and run the family home, or maybe they're like doing something else part-time while they're doing that. Sometimes you have two people that have the same income level, or sometimes you have one person that works somewhere in customer service making 60,000 a year, and you've got, because they love it and that's what they do, and they take care of the kids and they're full-time. And then you've also got somebody that's a software engineer making 250,000 a year. So there's a lot of different scenarios and things happening in these midterm marriages, in any marriage really. So when you think about that, how are you going to divide that community? You're not going to divide it 50-50, that's for sure. A 50-50 would be a home run slam dunk in most cases to the breadwinner, because you're never going to do worse than a 50-50 in that kind of a situation. And it's best case for you because you're probably going to give up more. So the financially disadvantaged spouse, or some people like to call it the less moneyed spouse, the person who's making less at the time of the divorce, and that's the story of the marriage, that person is typically going to take more from the community because it's going to take them longer to financially recover from the divorce. And there is some expectation that people exit the marriage, at least in a decent midterm marriage, on equal footing. So you don't have one person in a studio apartment and one person in a lakeside home. Like, that just doesn't work. So maybe, and these are just examples. I had a case recently, actually really recently, when this doesn't happen very often, but it was a really lopsided 18-year marriage. And so, that was like a 70-30. I mean, that's like a 70-30 division, because one person had a ton of separate property, made 600 grand a year, and the other person like made 130 and didn't have any separate property. So situation like that might be a huge disproportionate division. Another situation, a more common disproportionate division in a situation, is 60-40, 55-45. It really depends on the specifics of your marriage, and also what a percentage of the community is worth, because that's not the same for everybody, right? And what's going to happen with spousal maintenance. So midterm marriage means there's a lot to fight about. There's also a lot to negotiate, and hopefully you don't fight, right? But there's a lot of moving pieces. The idea is exit the marriage, especially if there's kids in each home, on somewhat equal footing. And then maintenance and property division is rehabilitative in nature, and that you're not going to have the same amount of money forever, but you are for a little while, and then things kind of tear down and everybody goes on their way. Unlike the short-term marriage where it was like, okay, we're done, everybody's moving on, right? There's definitely often maintenance as well in midterm marriages. And then we have the last category, which is long-term marriages. These are my favorite marriages, which is weird because it's kind of sad when people in a long marriage divorce, but by the same token, you're really looking at setting up these people for the rest of their lives, right? If you've been married 25 years or more, or you have, 23 years of marriage and 2 years of cohabitation, you're going to fall into that category. And there is specific case law that dictates property division, spousal maintenance in long-term marriages. The idea I really actually like is to equalize the parties. It sounds so simple. And long-term marriages, there's a difference in a long-term marriage where somebody got married at 20 and they're breaking up at 45, where somebody got married at 20 or 25 and they're 65, and it's like they're already retirement age. If you do or don't have working years left, that's going to have a bearing on how your maintenance works, or maybe property division works in a long-term marriage. But the principle is equality. A very common solution in a long-term marriage: family married 28 years, 50-50 division on everything, no matter what. And then the party that makes less is getting maintenance for a significant period of time, or equalization in retirement. If you're, we're equalizing retirement benefits and Social Security into perpetuity. So long-term marriages have special considerations that other marriages don't. They also have the possibility to invade separate property. This is like a whole other thing. I spoke to somebody the other day, and they're married like 22 years, and it's probably not going to work out. And this guy had a separate property business that's worth a lot of money. So right now he could walk away from the marriage, just divide the community, and keep that separate property business. Probably have a pretty good claim to do that. If he stays married a little longer, then instead of having, let's just say for the sake of discussion, this is maybe hopefully illustrative to you. Let's say you've got $2 million, and then he's got a $2 million separate property business. If you have $2 million and you're married 22 years, you're each probably getting, and you have relatively equal incomes, you're each taking $1 million and walking away, right? But if you're married 25 years or more, you've got $2 million in the community, $2 million in separate. Guess what? The court can invade separate property, and given the principles of equality, you're probably each walking with $2 million. So that person just lost a lot of separate property money by staying married longer. So anyway, that's something to think about. And that's a simplistic overview of it. But the point is, long-term marriages are forward-looking as opposed to backward-looking or rehabilitative. They're forward-looking. They want to put you in on equal footing because you've relied on the community for a long time. Long-term marriages also afford lifestyle maintenance. If you're used to being able to go on really nice trips and you have a vacation home and you're doing all these things and you're married, for a long time, the court is going to believe that you have a right to maintain that lifestyle. So that's something that doesn't happen in a 20-year marriage. So there's a lot of different things there. Melissa, I'll take a few more before I talk about other specific issues.
Sounds good. Got quite a few questions, so we'll.
This is a good topic, right?
Yeah, lots of
I love
questions.
this topic.
Okay, what if your 401k was acquired before the relationship, before cohabitation, still have the account, but it's from a past job and no contributions have been made since?
Cool. Oh, I'd love to talk about 401k for a minute. Okay, that's an easy one. You gave me a softball question. If you have a 401k and nothing's happened since then, it's before, it's your separate property. And the gains and losses on it, like, because, okay, let's say you have an account and you never rolled it over and you stopped contributing it in 2005, but you have it. So it's going to have gains and losses, right? And then you have 10 years of marriage after that and nothing happens. The gains and losses and everything in that account is separate property. You don't have to do anything with it. It's yours. But let me give a quick example where that wouldn't be the case. Let's say you work for Boeing and you've got a 401k there and you got a Boeing VIP and you got all this stuff. And you work there for 10 years. Then you got married in 2010. Let's say you worked there from 2000 to 2010, and then you got married. And so you have 10 years of contributions and you kept contributing, same account, same deal, right? So then you're married for another 13 years and now it's 2023. So you've got these accounts and they have 13 years of community contributions and 10 years of separate property contributions. And then you have the gains and losses on those 10 years. And then you have another bucket of gains and losses on the community years. So in that situation, what we would do is we'd get a valuation done that's going to tell us what the gains and losses are specifically on those 10 years and what the gains and losses are and on the community portion. So you're going to get a valuation done that tells you what are the community components and separate property components, but that's a mixed account. That's different than what you just described, but that's a very common scenario. So hopefully that helps somebody.
Awesome. Thank you. How would a vacation home in another state be divided?
It'd be divided, doesn't matter where it is. If it's property and you own and you acquired it, it's a good question though. A lot of people want to know that. It doesn't matter where it is. There is jurisdiction over a marriage and there's jurisdiction over marital property. If you live here, like I own a home in Arizona. I go there a lot, but it's in Arizona. It's not here. If I get divorced here, my Arizona home is still going to be part of my Washington divorce.
Great. Thank you.
Mm-hmm.
And a car owned by somebody prior to the marriage is also excluded from the
prior to the marriage. Yeah, definitely. Yeah. What happens a lot of the time, I put this in my prenups a lot because cars are so silly. I really like cars, but I'm also aware that they're not an investment and they're a utility and they're fun and all these things. But anyway, what happens a lot is you buy a car during the marriage and maybe one person, I don't know, maybe you have multiple cars and one person drives one car like all the time. It's their daily car. And then it comes down to it. And the other person's like, nope, I want that car. Or I'm the one that wanted it in the first place or whatever. People fight over cars and it's so silly. Like it's not worth fighting over. So I always like to put that the person who, if there's a question about whose vehicle it is and it's not a separate property vehicle, the person who uses it as their daily driver will get to keep it. And here's the other thing to know too. If you have a car and you're getting the car, this is another common one, you also take the liability. So like, let's say that I went and bought a new Tesla. And when I didn't pay for it in cash. I financed part of it. So if I'm getting the Tesla in the divorce, I'm also getting the loan. It's very rare that you're getting the Tesla and then the other party's paying off the loan for you. Sometimes that happens if it's part of like the big picture, but typically the way it is with any asset, community asset, if you take the asset, you also take the liability. So just a note about that. That seems to confuse people, but
yeah.
Anyway.
This one might be a little too fact specific. If one party purchases a home before the marriage, okay, but both parties moved into it at the same time, are there any rights there, especially if there's a huge gain in property value?
Maybe
a part of
maybe these are the fun ones to talk about. Property. Yeah. All right, let me give you an overview on this. This is actually a good question because this comes up a lot. So, okay, here's the scenario. First of all, and this is a big thing for you. Let me just give you a 2-minute overview, but I'll come back to your property question, but this matters. Committed intimate relationships in Washington. Washington recognizes what are known as committed intimate relationships. They used to have an uglier name, which was meretricious relationships. So if you ever hear that, it means the same thing. But committed intimate relationships means just that. It was committed, it was intimate, it was a relationship, it was exclusive, you were together for a period of time. It's what Washington calls a marriage-like relationship. It's living with someone in Washington. If you do that for 2 years or more around that, there's not a deadline, but I've had committed intimate relationships that were as little as 2 years or as many as like 25 years. If you live with someone, property rights attach. Spousal maintenance is not available and attorney fees are not available, but you get property rights. So in your scenario, and I'm assuming you can prove committed intimate relationship. It's not an automatic thing. Someone still has to prove that it was. But let's say this came up in another recent case, probably a million times a year. You're living with somebody in an apartment. You're living together, things are going great, everything's whatever. And then one person is like, wants to buy a house, but you haven't really been together long enough that you're buying it together. So one person's like, I'm going to buy a house. Other person's like, oh, this is so great. You get a realtor, you go out and look at property together. It's like a fun thing that you do. So this other person who doesn't own the house is like all invested in it and they feel like they're all in, right? And then you get married and you live there. And then you live together, then you get married and you live there. And then later you get divorced and the person who bought the house is like, okay, that's my separate property house. And the other person is like, oh no, we bought that together and it should be part mine and I should have part of the equity. So what's going to happen in that situation? Well, here's the critical thing. If you were living together beforehand in that apartment before you went out and looked at the property and like were in love and everything, if you were doing that, right? Then there is a presumption. If someone claims committed intimate relationship, there is a presumption because it was bought during the cohabitation period that it is community. And then we get the really fun part, which is the person who owns the home, if they have the burden of proving that it's separate property. So they're going to trace back, okay, all of this down payment came from before I knew this person. So it's a separate property down payment that purchased this home. And so even though we live together, there's a rebuttable presumption, and I have met my burden of showing that all my funds were used for this. It's completely separate property. The other person wasn't on title. There's no property rights for this other person in that piece of property, but you got to be able to show it. What happens sometimes, which is really rough on people, is you're living together for like 10 years and one person's maybe the breadwinner. So you've saved a lot of money, you've got a 401k, you got all this stuff going on. The other person maybe works part-time or doesn't work that much or whatever. Then you buy a house and the person says, oh, well, they try to do that tracing exercise. And they try to say it's mine, it's mine. But the money that they used was all earned while you were living together during those 10 years. Guess what? That's a community house. So the source of the down payment is very, very important. However, if you're married and you're both on title and that's the situation, it doesn't matter. Like, I mean, you might have a separate property down payment that you can trace back, but if you're married, you're both on title, you bought it during the marriage, then it's a community home. So there's a lot of nuances with property. So anyway, for that person that asked that question, were you living together before? Because if you were living together before, you're probably going to have a rebuttable presumption that it's community-like character if you weren't married and you got to trace it back. If you got married, like, and let's say you weren't living together before and you bought the house and then you got married right after that, you probably will be able to show that separate property. That's probably not gonna be a problem for you. But again, these are very fact specific, but really good questions. I could talk about property rights and all that kind of stuff all day, but I won't. I'll answer one or two more and then I'll finish this.
Okay. Well, on those same lines, if a party does own a property prior to the relationship, but then they refinance during cohabitation, if the party who does not own the home makes non-financial contributions, does it change anything? Does it remain separate property owned by the person?
No, here's the thing though. I know where you're going with that. If you own the home beforehand and then you refi, this happens so often, and you're married now and you're like, oh, well, I think I have to put my spouse on it, and you don't have them sign that quitclaim I mentioned earlier that says it's not their property. You put them on. If you put them on, if it was a separate property home, you have what we've called transmuted the property. You've taken it from being separate property and you've changed it to community. But if you own the home before and you just refinanced and they didn't put them on it, then it stays separate property. As far as this is important to note too. All right, let's say I'm living in a house. I owned it way before I ever knew my husband. I paid for it. It's my thing, whatever. But then let's say he pays me like $1,500 a month towards bills and mortgage and all that stuff because he lives there. Is he developing an interest in the property? No. And the reason why is that any amount he's paying would just be reasonable rent because he's got to live somewhere. So it's like he's got to live somewhere. However, if he was living in the house and he's like, God, your kitchen sucks. It's terrible. I can't cook in here. I want to redo your kitchen. And I'm like, okay, I would love a new range. Sure. And he takes his own money, or we take community money that we have earned during the marriage and we spend $80,000 to redo the kitchen, then it didn't change the character of that property, but there is a community lien on the property because his money was used for that, or community money was used for that kind of an improvement. So there's a lot of different things that can happen with that. I could keep going, but I think that's
Yeah,
enough.
let me ask a couple fairly quick questions, hopefully.
Sure.
If your spouse buys an asset and puts the title under an LLC during the marriage, is it considered community property?
Yeah, I mean, yeah, again, it's the same thing. Name on title doesn't matter. If you have an LLC that is specific in the articles of incorporation, that is part of your separate property. I mean, if there's titling issues with the LLC that make it clear it's separate property and you use separate property resources to establish it, or you're putting separate property into it, like a holding company or something, it could be separate property. But the presumption is just because you title it to an LLC does not make it separate property. So.
And how about as a business owner, how is my income calculated, based on my net or my gross?
Good question. Business owners are paid different ways. If you are somebody who is taking a W-2 from your business, I'll give you a couple of common scenarios. A common scenario is like an S corporation, where someone gets a W-2 and then they have what we call pass-through income that reports on a K-1. So in that kind of a situation, your reasonable wages, if you are a business owner, you have to pay yourself reasonable wages in accord, or you at least have to have accounted for reasonable wages in accordance with like what your revenue is. So let's say you're a business owner, you've got a $5 million business and you're paying yourself 50 grand a year. That's not going to count. Like, then we're going to be looking at, what are you doing with the rest of that money? Are you putting it back into the business? Is it being paid to you later in a dividend that's not, or a draw or something that's not reported on your W-2? You can't like alter your income that way for purposes of a divorce. It needs to be a reasonable income. For the most part, if you have a separate property business that's already your separate property business, reasonable wages during that business might be community, but they might not. It really depends on how your business is set up. If you're a sole proprietor, if you have employees, all kinds of things like that. But the most important thing to know is your reasonable wages are typically going to be community, but not necessarily like your extras. Let's say you have a W-2 and you're maxing out your W-2 at what your maximum Social Security and Medicare contribution is. If you're doing that, okay, that's probably going to be W-2. But then let's say you have pass-through income, or you have income on a Schedule C or something like that. That might not be if it's a separate property business. It probably wouldn't be, because those are your gains. But if you didn't specify that your wages weren't, that's another thing. Businesses are a whole other thing. And that's one thing I was going to talk about. Let me just run through this really quick, and then I'll spend the rest of the time on any questions. What are the nuanced issues that come up? We've talked about a few of them. We have, but valuation of assets and valuation of a business is something that comes up a lot. So you'll need to assign a fair market value to each asset for purposes of division. That includes a business. It is common, if you're a business owner, that you'll need to have a business valuation done, unless it's a business where, like I said, you're a sole proprietor. If you're the only person working in the business, that's pretty easy to figure out. It might have no value, or it might just be your wages. But if you have a business that's been operating for a while, you'll need to have a valuation done to determine what's the value of that business for purposes of division or for recognition as your separate property. And is there a goodwill component in the business? That's usually in, professional services, financial services, a dental practice, a law practice, things like that have a goodwill component in addition to the rest of the value. So business valuations are very, very common. Asset valuations, excuse me, are common, and you need them. Like I mentioned, that mixed character 401k, you would need it for something like that. You need sometimes a basic valuation for determining the separate and community interests in RSUs. If someone's granted a bunch of RSUs, what that looks like. So there's different kinds of valuations that you need to get, and your attorney can help you with that. Separate property claims, like I said, they're going to require the person who's claiming a separate property, whether they owned it prior to marriage, or it was an inheritance, or it was gifts, they're going to require tracing. So you're going to have to do that. Commingling, this is another thing that comes up. This is when separate and community assets are combined or mixed together. It can complicate the process of dividing, and you can lose your property, your separate property, to commingling. So if you got 100 grand from your grandma, and then you're like, I don't know, we need some money around the house, we're going to, remodel a bathroom, and you put 50 grand into a community account, and other money is going in and out of there too. Everybody's paychecks are going in and out of there, and you can't tell that 50 grand went to this or that. It's commingled beyond recognition. You put it in there, you used it, everybody relied on it. It's pretty much gone. So in some ways you might be able to trace it out, but you just don't want to do that. So commingling can change the character of property. That's when you combine. Transmutation changes the character of property, which is I intended to make this community and I signed something. That transmutes it from the character of property being established at the time it's acquired, whether it's an account, whether it's a piece of property, it doesn't matter. So that's really, really important. Another note about business ownerships, dividing family businesses and closely held businesses can be complex. So you have to evaluate the assets, and then you have to decide whether to sell, buy out the other person, who's going to continue running the business. Do people work together in the business? Is one person had wages that weren't compensated? All kinds of fun or not fun stuff comes up there. One thing I would say too, tax implications are important. So considering tax consequences of different property division options, capital gains taxes, sometimes someone will decide to sell a home together because you're going to take advantage of the higher gains exemption of 500K versus, and the sharing in the cost of sale. Whereas let's say you had a family home and you thought, I want to keep the home, and then it's a year later and you realize you can't afford it. Well, number one, now your gains exemption as a single person is half as much. And number two, you're going to basically shoulder that estimated whole 10% cost of sale on your own. Whereas if you'd made the decision sooner to sell it as part of the divorce and part of settlement, you would share in the cost of sale, you'd have the higher gains exemption, and it'd be a better situation for you. So when you're considering property tax implications, definitely comes up. Potential tax liabilities associated with retirement accounts and investment properties are also important. You don't want to look at a retirement account that's not a liquid account, like, oh, I just got $100,000 and I need that money, so I'm going to cash it out now. Well, you're not cashing it out dollar for dollar, and you're going to have some penalties that you're going to have to pay, whether it's going to be income to you. Anyway, I'm not going to give you tax advice because I'm not qualified to do that, but I can tell you that tax implications really factor in when you're looking at dividing a more complex portfolio. So anyway, I could say a lot more, but I think we only have about 10 minutes left. So if you want Melissa to give me a couple more questions, I'll take those because I'm sure they'd rather hear that.
Yeah, there are a few more questions. Some questions are off topic, so I'm trying to stick to the ones that are in topic as much as possible. I think this one's kind of been answered, but if I bought an investment property outside of Washington before the marriage, I still pay the mortgage on it. Will I get the property? It will be divided. Sounds like there's a lot of.
If you're married, like long-term, it might be divided, but if you're not, it sounds like it's separate property. So,
yeah,
I mean, I can't promise you that, but it sounds like it based on what I know.
This is off topic, but I think relevant to anyone who's involved in a divorce case potentially. What is the role of a mediator? Can they help with expediting the divorce case before the hearing? This person says their hearing's a month away. What's the role of a mediator? Maybe you could just kind of talk briefly about that.
Oh yeah, this comes up all the time, so you should know. A mediator might be an attorney or it might be a non-attorney. If you're using a non-attorney to mediate your divorce, don't do it, please. I can tell you, just don't do it. Anyway, so mediators are typically people who used to practice family law, or maybe they're retired judges. They're people with legal experience that know how to help you settle a case. So a typical family law, there's different types of mediation. Very common mediation between you and your spouse with no attorneys is a round table where you're sitting across the kitchen table and mediating, right? Second level is maybe you're doing a mediation where you've used somebody and you're not using attorneys, and everybody's just going to this mediator and they're expecting the mediator to solve their case. You might sit across from each other or in the same Zoom screen or whatever you're doing these days, and that mediator might try to help you through the issues. That mediator, even if they're an attorney, they're not your attorney or the other party's attorney, and they ethically cannot give either of you advice and say, this is a good deal for you or this is a bad deal for you. They can just help you talk through the issues and come up with some kind of a decision. What happens in those scenarios a lot is somebody, maybe the less moneyed spouse, agrees to a 50-50 division because they think, oh, everything's just getting split, I'm getting half. They don't realize they might have gotten 60%. They probably left hundreds of thousands of dollars on the table in a situation like that. Can't tell you how many times I've seen that happen. So there's those kinds of mediations where it's not an attorney-led mediation and you have no legal counsel, but you have a mediator and they're trying to help you through it, but they can't give you legal advice even if they're an attorney. And then you have the most common and effective mediation, which I would say settles almost every case, not every case, but almost every case, has settled cases for me I never thought would settle. And that is what's called a shuttle mediation, where both parties have counsel. So that is where the mediator shuttles back and forth between two rooms. If you were at my office here, maybe you'd be hanging out with me in here, maybe they'd be down in a conference room and you'd never see the other party, and the mediator would shuttle back and forth in person. That's how we used to do these mediations. Now in the COVID era, sometimes we still do. I did an in-person one a month ago, which was kind of cool. Hadn't done one in a while, but now we do them on the screen. So you'd be here talking with me, they'd be in another Zoom room, you'd never see them, and the mediator pops back and forth and shuttles back and forth. And it's a long day, but it usually gets it done. So in that kind of a mediation in your room, you have the ability to, and that's also what's called an evaluative mediation, where you have the ability to get advice from your attorney, send offers back and forth, and that mediator that has experience is going to evaluate your positions privately and be like, this is what I think. And they're going to poke on all the weaknesses of your case and do the same thing in the other room and try to help you come together and settle your case. That is effective. It is extremely effective in my experience in doing this. And I think most people would tell you the same. So there's that kind of mediation, and that kind of a case. Mediators still can't give you advice, but they give their opinion. And you're talking to your attorney and you're getting advice in real time, and you're exchanging offers and things are moving along, and you're probably going to settle most of the time. So there's also collaborative mediation. Which is a different kind of thing, where you opt into what's called a collaborative participation agreement. Both parties have counsel. There's other people on a collaborative team. Maybe there's a financial person, maybe there's a therapist if you have like parenting issues, and you're going to collaborate in a series of meetings and sit together and have these discussions in the open. And that is very different as well. And that's a whole other set of rules I'm not going to talk about today. I'm too tired.
This is, I'm not going to ask this question because it's a little off topic, but maybe kind of tied into what you're saying. How can we talk about when there's a party that's trying to sort of delay things and trying to buy time and continues to file continuances? How can you expedite things? How can you try to help move things along?
Well, you can't really like expedite things any faster than your case schedule. I'm going to assume for purposes of this discussion, you're in King County and we have a case schedule. Not every county has the case schedule. Everybody has different rules, but King County is a big county and we have a case schedule. You file a case, you get a schedule. It gives you a trial date at the end. It also gives you a mediation deadline, which is typically like 10 months, 11 months later. So you can't force somebody to mediate sooner. I often will try because I'm like, let's just get everything we need to get exchanged and go to mediation. But sometimes it takes a while. So if you have somebody in the other side of the camp and they are like trying to continue trial, or they change attorneys or whatever, so they're going to get a trial continuance. Family court hates to hear family law trials. The court hates it. So, and they're busy, and you have to take criminal cases before your family law case because there's constitutional rights implicated. And fortunately, there's been less of a backlog now post-COVID, but for a while, family law cases were really getting kicked down the can. And, you know, family law cases with no kids are even lower priority. Cases with kids are prioritized. So if there's a good cause reason to continue your trial, somebody got a new attorney, somebody's experts out of town, somebody has a medical issue, it's going to get continued. If that's going to keep happening though, is another case. And if you have somebody who's gotten multiple trial continuances, then what you need to do is you need to oppose the trial continuance by filing your response. When they make them file a motion, don't agree to it like after the third one or second one, and you're going to object and you're going to say why it's prejudicial to you, why this needs to go forward. And then usually the court will be like, okay, no continuance. I've had that happen. Or they'll say last continuance. So anyway, it can be really frustrating. But the bottom line is you can't accelerate things any faster than your case schedule. You just don't want your case schedule to keep getting reissued and having continuances if you're in a hurry to resolve your case. And I'll say this too. I mean, divorce in Washington is very choose your own adventure, which basically means you have the opportunity to negotiate your case or handle your case the way you want within certain approaches. But it's also a marathon and not a sprint. A friend of mine, his name is Rafe Palmer, and he wrote a book that's very good. I think it's called I Just Want This Over. And I think that's the exact words. Anyway, and Rafe's book is like that's what every client says to us. He owns a family law firm in Chicago. And what do people say? I just want this over. How many times have I heard that? I just want this over. And I'm like, hey, I want this over for you. Like, as much as you think I want to drag this out because I want your money, trust me, I don't. I've got 300 other cases in this office and I want you to be happy and move on with your life. If I didn't want people to be happy and move on with their lives, like I literally wouldn't do this work. work because it would be miserable. Most attorneys feel that way. Their clients want it over, but you're going to be in a marathon, which means you have to do the legwork. You have to do the conditioning work. You've got to prep for it. You've got to be prepared to run the whole race. If you're like busting it out, you're going to tap out at like the 10K mark. You're not going to make it to the finish line. So you really need to think about that, and you need to get good guidance to understand what the stages are. And you're going to be frustrated at times, and that's okay. That's why you need a therapist, somebody like Melissa, somebody to like keep you in check and kind of help you deal with the stress. Because if you come to me and you want to tell me how upset you are, I want to hear. I'm going to sympathize with you, but I can't give you the tools to help you get through it. And you'd be paying me way too much money to talk about those things with me. I'll listen, but I'll probably tell you, if you have a therapist, like, let's set up a session for you about what's going on, you know, because I can only do so much. So anyway, those are a few little tips. Thank you for coming to my webinar. We do these every month. I don't know what our next topic is off the top of my head, but we'll send you an email about it, I'm sure. So thank you for coming. I'll let Melissa wrap it up, and have a nice day.
Thanks, Michelle. Yeah, thank you for attending. We got to most of the questions. Apologies if we didn't get to yours. I do have a question here about whether I take insurance. I don't, unfortunately. All my clients are private pay and counseling, but I do provide super bills for people who have out-of-network coverage, and we can definitely talk about that. Shoot me an email. Shoot Michelle an email. If you guys have more questions about your legal case, or you need to consult with an attorney, or you have fact-specific questions that we can't answer in a forum like this, like Michelle said, it's really important for you to be well supported in all ways throughout this process. So please do contact the law firm, contact me if you're interested in counseling. Get your village together, because you don't need to do this alone. Okay, thank you so much, everyone. Take care. Bye-bye.